Maya has $100 left after rent, food, and the bus ride to work. She could use it for a small break or place it in a Roth IRA and leave it there for years. The choice feels small. The tax result may not be. A Roth IRA can change what happens to that money later, but only if Maya understands what she gives up now, what she may gain later, and what the rules allow. Her paycheck is not large. Some months, the car needs a repair. Some months, a family bill arrives without warning. So her $100 monthly plan is not a test of willpower. It is a test of room. If she invests money she may need soon, the plan can create stress. If she waits for a perfect time, 10 years may pass with no account at all. The simple math gives her a clear starting point. $100 each month is $1,200 each year. Over a 30-year timeline, her total contributions would be $36,000 before any market growth. That number is not a forecast. It is only the money she put in. The account balance could be higher, lower, or close to that amount because investments rise and fall. A Roth IRA uses money that has already been taxed. Maya does not get a tax break for putting $100 into the account in the usual case, but qualified withdrawals later are generally tax-free. That can include her contributions and investment growth if she follows the rules. The key word is qualified. Tax rules depend on age, timing, account history, and the reason for a withdrawal. A traditional IRA works in a different order. Maya may be able to deduct some or all of her contribution from current income, depending on her income, workplace plan, filing status, and the 2026 IRS rules. The money can grow inside the account without yearly tax on each trade, but withdrawals are generally taxed as income. The tax bill moves from the front of the journey to the back. That difference matters because Maya is choosing more than an account name. She is choosing when to face taxes. With the Roth IRA, she pays tax before the money enters. With the traditional IRA, she may lower taxable income now if she qualifies, and pay income tax when money comes out. No one can know her future tax rate with certainty. The better fit depends on facts that may change. Suppose Maya keeps adding $100 each month for 30 years. If the account earned a sample average of 5% a year with monthly compounding, the balance might be about $83,000. At a sample 7% a year, it might be about $122,000. These are illustrations, not promises. Real returns vary. Some years may bring gains. Others may bring sharp losses. In those examples, Maya contributed $36,000. The rest would be hypothetical growth. In a Roth IRA, qualified growth may be withdrawn tax-free. In a traditional IRA, much of the withdrawal may be taxed as ordinary income. That does not mean the Roth always wins. A traditional IRA deduction today can have real value, especially for someone in a higher tax bracket who may face a lower rate later. Her next question is about the tax break she can feel right now. If a traditional IRA contribution lowers her taxable income, that may leave more cash in her pocket at tax time. But the benefit depends on whether she qualifies, and it may be smaller than expected. A tax deduction is not a tax credit. It lowers income subject to tax. It does not erase the whole contribution. Maya also checks the money she already has. She has no emergency savings yet, and a credit card balance with a high APR. The Roth IRA may be a strong long-term tool, but it cannot replace cash for next month's rent. Paying high-interest debt and building a basic emergency fund may deserve attention before she locks every spare dollar into investing. The best plan must survive real life. That is the trade-off between growth and access. Retirement accounts have rules because they are built for long-term saving. Some Roth IRA contributions may be withdrawn under certain rules, but investment earnings can face taxes or penalties if the withdrawal is not qualified. Traditional IRA withdrawals before the permitted age can also face tax and penalties, with exceptions in some cases. The details matter more than a simple promise of easy access. So, Maya creates a small cash buffer first. She does not need a perfect fund before she begins. She chooses an amount she can keep without missing a bill, then sets the monthly transfer after payday. If $100 is too much in a hard month, a lower amount may be more useful than a plan that stops. Consistency is helpful, but flexibility protects consistency. Her account also needs an investment. Opening an IRA does not automatically invest the money. Cash can sit inside the account until she chooses a fund or other investment. A broad index fund or ETF may spread money across many companies, which can lower the risk of relying on one company. It still carries market risk. Diversification can help, but it cannot prevent losses. Fees become part of the story, too. A small yearly fee can seem harmless, yet fees reduce the money that stays invested. Maya reads the fund prospectus and checks the expense ratio, which is the yearly cost charged by a fund. She does not need to predict the next winning stock. She needs to understand what she owns, what it costs, and whether the risk matches a 30-year goal. Then the market drops. Her account balance is lower than the money she has put in. The loss feels personal, even though markets move for many reasons she cannot control. She thinks about stopping the transfer. But a lower balance is not the same as a final result. Selling during a drop can turn a temporary decline into a lasting loss. Staying invested may help, but no path is certain. Maya remembers why the timeline matters. She is not saving for a bill due in 3 months. She is building a retirement account meant to serve her much later. That longer period gives her more time to face market swings, though it does not remove risk. If her goal changes to a home repair or a near-term need, the account may be the wrong place for that money. The tax choice can also change as her life changes. A first job, a new employer plan, a marriage, a move, or a rise in pay can affect IRA deductions and contribution limits. Roth IRA income limits and other rules apply. The 2026 IRS rules should be checked before acting because limits and phase-outs can change. General education is useful, but current official guidance controls. Maya compares 2 paths without pretending to know the future. In the Roth path, she pays tax on the money today and may receive qualified withdrawals tax-free later. In the traditional path, she may get a deduction today if eligible, then owe income tax on withdrawals later. The right question is not which account sounds better. It is which tax timing fits her income, goals, rules, and comfort with uncertainty. She also asks what happens if she changes jobs. A workplace 401k, if she has one, can affect whether a traditional IRA contribution is deductible. It may also offer a match, and missing a match can be costly because it means leaving part of a workplace benefit unused. Her whole money system matters. An IRA is one tool beside cash savings, debt payments, insurance, and workplace retirement choices. The $100 now has a job for every month. Part goes to a cash buffer until it reaches a useful level. Part may go toward the high-interest card. Later, more can move into the Roth IRA or traditional IRA based on her facts. This is not a dramatic rescue. It is a sequence. Each step lowers one kind of pressure before adding another long-term task. There will still be setbacks. Maya may skip a month when the car breaks. That does not erase the months before it. She can restart when the bill is handled, review her automatic transfer, and avoid treating one pause as a failed identity. A plan should be judged by how well it works through ordinary problems, not by how perfect it looks on paper. The most important number may not be the projected balance. It may be the amount Maya can repeat without fear. $100 a month can become $36,000 of contributions over 30 years. Hypothetical growth could add to that, but the market decides what actually happens. Taxes decide how much of the final money may be kept. Fees, withdrawals, and missed contributions shape the result too. The Roth IRA gives Maya one kind of certainty. If she follows the rules for qualified withdrawals, the growth is generally tax-free. The traditional IRA gives a possible benefit sooner, a deduction for those who qualify. Both choices carry limits, conditions, and risk. Neither account turns a small payment into a guaranteed fortune. The calm choice is the one based on current facts, future needs, and a plan she can keep. Before she acts, Maya checks the IRS guidance for 2026, reads the account rules, reviews the fees, and asks whether she may need the money soon. She considers her tax rate now and the chance that it may be different later. She also checks debt and emergency savings. These questions do not remove uncertainty. They turn a confusing choice into a set of clear decisions. Her $100 is still $100. Taxes do not change the amount she sends each month. They change the path that money takes through time. A Roth IRA may trade a tax benefit today for possible tax-free qualified withdrawals later. A traditional IRA may trade taxes later for a possible deduction now. The lasting lesson is not to pick one account blindly. It is to understand the rules, respect the risk, and build a plan that can live with the person making it. If you want to take control of your finances, subscribe for more money tips every week.